Good day. Here are the latest developments from the global commodities and financial markets. Gold prices moved lower in early trading, while U.S. equity futures advanced, reflecting a shift in investor sentiment toward risk assets. At the same time, comments from market strategists, political developments involving former President Donald Trump, and signals from the U.S. Supreme Court and Federal Reserve shaped the broader market environment. Investors are also closely watching upcoming economic data for further guidance on monetary policy. Spot gold declined by 0.4% to $4,819.39 per ounce as of 8:57 a.m. Eastern Time, or 13:57 Greenwich Mean Time. This followed an earlier drop of nearly 1% during the same trading session, indicating sustained downward pressure on prices through the morning. In the futures market, U.S. gold futures for February delivery also recorded losses, falling 0.3% to $4,121 per ounce. These movements marked a pullback in gold after previous strength, as market participants reassessed their positions in response to changing conditions across equities and macroeconomic signals. The decline in gold prices came as U.S. stock index futures moved higher on Thursday. Futures gains suggested a renewed appetite for buying among investors, pointing to improved confidence in risk assets. This shift in sentiment followed comments from former President Donald Trump, who signaled a moderation in his earlier stance on tariffs aimed at European countries. His decision to dial back the threat of tariffs appeared to ease some concerns in the market, encouraging investors to move back into equities and away from traditional safe haven assets such as gold. Market analysts noted that this renewed risk appetite played a central role in gold's decline. According to Bart Mellick, global head of commodity strategy at TD Securities, the resurgence in risk-taking behavior prompted investors to be less cautious toward risk assets. This change reduced demand for gold and led to some degree of profit-taking in the precious metal. His remarks reflected a broader view that gold prices can face pressure when confidence in equities improves and investors seek higher returns elsewhere. Beyond market movements, geopolitical and political developments also featured prominently in the day's news. Former President Trump announced the launch of what he referred to as a Board of Peace. The initiative was initially designed to help stabilize and support the fragile ceasefire in Gaza. However, Trump indicated that he envisions the board taking on a broader role beyond its original scope. His comments suggested an expanded ambition for the initiative, although specific details about its future responsibilities were not outlined in the remarks. On the issue of Ukraine, Trump stated that peace efforts were getting close. These comments were made ahead of a scheduled meeting with Ukrainian President Volodymyr Zelensky in Davos. The statement drew attention from global observers, given the ongoing conflict and the importance of diplomatic efforts aimed at resolving it. While Trump's remarks pointed to progress, no further specifics were provided regarding the nature or timeline of these peace efforts. In the United States, attention also turned to the judiciary and the Federal Reserve. During arguments before the U.S. Supreme Court related to Trump's attempt to dismiss Federal Reserve Governor Lisa Cook, several justices appeared receptive to the idea that the central bank's independence in setting monetary policy should be preserved. The discussion highlighted the importance placed on the Federal Reserve's autonomy, particularly in decisions related to interest rates and broader monetary policy. The outcome of these arguments has implications for the balance between political authority and central bank independence, a topic closely watched by financial markets. Meanwhile, expectations surrounding the Federal Reserve's next policy decision remained largely unchanged. The U.S. Central Bank is widely expected to keep interest rates steady at its policy meeting later this month. This expectation has been factored into market pricing, with investors showing limited anticipation of immediate changes to borrowing costs. Instead, focus has shifted to upcoming economic indicators that could provide further insight into the Fed's future policy direction. One such indicator is the Personal Consumption Expenditures Price Index. Investors are awaiting the release of November PCE data, scheduled for 10 a.m. Eastern Time. The data is closely monitored, as it is the Federal Reserve's preferred measure of inflation. Market participants are looking to the report for cues on the Fed's policy path, particularly in terms of how inflation trends may influence future interest rate decisions. Until then, trading activity reflects cautious positioning ahead of the release. While gold moved lower, other precious metals showed mixed performance. Spot silver edged higher, rising 0.2% to $93.47 per ounce. This increase came after silver reached a record high of $95.87 per ounce earlier in the week, on Tuesday. Despite the recent gains, analysts cautioned that silver prices may be experiencing some degree of overextension. Bart Mellick noted that silver appeared somewhat overdone at this stage and suggested that prices could begin to correct once retail-driven pressure subsides. He also pointed to increasing global liquidity, which he said could eventually contribute to a reversal in prices. Platinum prices, on the other hand, recorded a stronger advance. Spot platinum rose 1.5% to $2,520.45 per ounce. This gain followed a previous session in which platinum touched a record peak of $2,511.80 per ounce on Wednesday. The move highlighted continued interest in the metal, even as other parts of the precious metals complex showed signs of consolidation or correction. Palladium also moved higher, gaining 1.1% to trade at $1,960.25 per ounce. The rise in palladium added to the mixed picture across precious metals markets, where individual metals responded differently to shifts in investor sentiment, liquidity conditions, and broader economic signals. Taken together, the day's developments underscored the close relationship between financial markets, political signals, and economic expectations. Gold's decline reflected a move away from defensive positioning as equity markets showed signs of strength. At the same time, comments from political leaders, judicial discussions on central bank independence, and anticipation of key economic data continued to shape investor behavior. As markets digest these factors, attention now turns to the deeper details behind these movements, including the interplay between risk appetite, monetary policy expectations, and the performance of individual precious metals. In the next part of this report, we will examine the first half of the detailed news breakdown, focusing more closely on the drivers behind market sentiment and the implications for commodities and financial markets. Continuing with a closer examination of the developments shaping the markets, it is important to look more carefully at the interaction between investor sentiment, policy expectations, and the performance of precious metals during the session. The movements seen in gold, silver, platinum, and palladium did not occur in isolation. They reflected a broader recalibration by investors responding to signals from equity markets, political statements, and institutional considerations tied to monetary policy and governance. The decline in spot gold prices during the session highlighted how sensitive the metal remains to shifts in risk perception. As spot gold slipped to $4,119.39 per ounce by mid-morning Eastern Time, the earlier near 1% drop underscored the extent of selling pressure that emerged once confidence in risk assets improved. Gold is widely regarded as a hedge against uncertainty and volatility, and when market participants perceive reduced immediate risk, demand for such protection can ease. This was evident as investors moved to take profits following earlier gains, adjusting their portfolios to reflect a more optimistic outlook on equities. The futures market mirrored this trend. February delivery contracts for U.S. gold futures declined to $4,121 per ounce, down 0.3%. Futures prices often provide insight into expectations for near-term price movements, and the decline suggested that traders were not anticipating an immediate rebound. Instead, pricing reflected a cautious stance as participants awaited additional clarity from economic data and policy-related developments. The alignment between spot and futures prices reinforced the view that the downward move was driven by a broad-based shift in positioning rather than isolated trading activity. A key factor behind this repositioning was the rise in U.S. stock index futures. The advance in futures markets indicated that investors were preparing for stronger equity performance, which in turn reduced the appeal of non-yielding assets such as gold. The catalyst for this shift was linked to political developments, specifically former President Donald Trump's decision to soften his earlier rhetoric on tariffs targeting European countries. Tariffs have historically been associated with increased market uncertainty and concerns over global trade disruption. By dialing back the threat, Trump appeared to alleviate some of those concerns, contributing to a more constructive tone in financial markets. This improvement in sentiment was captured in the comments from TD Securities' Bart Mellick. He pointed to a significant resurgence in risk appetite, noting that it encouraged investors to be less cautious toward risk assets. As a result, gold saw reduced demand, accompanied by profit-taking from those who had previously benefited from higher prices. His remarks provided context for the market's behavior, emphasizing that the movement was less about negative fundamentals for gold and more about changing preferences among investors in response to external signals. At the same time, political developments extended beyond trade policy and into broader geopolitical initiatives. Trump's announcement of a board of peace introduced another dimension to the day's news. Initially designed to support the fragile ceasefire in Gaza, the board was presented as a mechanism aimed at stabilizing an already delicate situation. Trump's indication that the initiative could take on a wider role suggested ambitions beyond its original mandate, although no additional details were disclosed. Markets generally respond to geopolitical stability with increased confidence, and while the immediate impact of this announcement on asset prices was not explicitly measured, it formed part of the overall backdrop influencing sentiment. Further attention was drawn to Trump's comments on Ukraine. His statement that peace efforts were getting close came ahead of an anticipated meeting with Ukrainian President Volodymyr Zelensky in Davos. Such remarks are closely watched by investors, as developments related to geopolitical conflicts can have far-reaching implications for energy markets, commodities, and global economic stability. However, in the absence of concrete details or confirmed outcomes, the comments served primarily as an indicator of ongoing diplomatic engagement, rather than a definitive shift in circumstances. Domestically, the focus on the U.S. Supreme Court added another layer of complexity. During arguments concerning Trump's attempt to remove Federal Reserve Governor Lisa Cook, several justices appeared to support the principle that the central bank's independence should remain intact. The discussion highlighted the importance of maintaining a clear separation between political influence and monetary policy decision-making. For financial markets, the independence of the Federal Reserve is a cornerstone of credibility and stability, and any perception that this independence might be compromised can influence expectations around interest rates and inflation management. The court's apparent inclination to preserve this independence was therefore viewed as a stabilizing signal. It reinforced the idea that monetary policy decisions would continue to be guided by economic data and institutional mandates rather than political considerations. This context helped anchor expectations that the Federal Reserve would proceed cautiously and predictably in its policy approach, reducing the likelihood of sudden or unexpected shifts that could disrupt markets. In line with this view, expectations for the Federal Reserve's upcoming policy meeting remained steady. The central bank is widely anticipated to hold interest rates unchanged at this month's meeting. This consensus reflects a belief that current policy settings are appropriate given prevailing economic conditions. As a result, attention has turned away from the meeting itself and toward the economic data that could influence decisions further down the line. Among the most closely watched indicators is the Personal Consumption Expenditures Price Index. With the November PCE data scheduled for release at 10 a.m. Eastern Time, investors positioned themselves cautiously ahead of the report. The PCE index is the Federal Reserve's preferred measure of inflation, and its readings can provide valuable insight into underlying price pressures within the economy. While no assumptions were made about the outcome of the data, its importance lay in its potential to shape expectations regarding the future path of monetary policy. Alongside gold, movements in other precious metals offered additional perspective on market dynamics. Spot silver's rise to $93.47 per ounce represented a modest gain of 0.2%. This came after silver reached a record high of $95.87 earlier in the week. The recent surge in silver prices had attracted attention, and commentary from market strategists suggested that the metal may have moved too far, too quickly. Melek's observation that silver appeared overdone pointed to the possibility of a correction once retail-driven demand eased. He also referenced the role of global liquidity, noting that increased availability of liquidity could eventually lead to a reversal in prices. This comment underscored the complex interplay between investor behavior, liquidity conditions, and price movements. While silver continued to trade near elevated levels, the caution expressed by analysts highlighted the risks associated with rapid price increases unsupported by sustained demand. Platinum's performance stood out for its relative strength. The metal climbed 1.5% to $2,520.45 per ounce, building on momentum from the previous session when it touched a record peak. The rise indicated ongoing interest in platinum, setting it apart from the more subdued movements in gold. Palladium also advanced, gaining 1.1% to $1,960.25 per ounce, adding to the mixed performance across the precious metals complex. These varied movements illustrated that while overarching sentiment influences the sector as a whole, individual metals can respond differently depending on market-specific factors and recent price action. As the session progressed, investors continued to weigh these dynamics carefully. Taken together, the day's developments underscored the close relationship between financial markets, political signals, and economic expectations. Gold's decline reflected a move away from defensive positioning as equity markets showed signs of strength. At the same time, comments from political leaders, judicial discussions on central bank independence, and anticipation of key economic data continued to shape investor behavior. As markets digest these factors, attention now turns to the deeper details behind these movements, including the interplay between risk appetite, monetary policy expectations, and the performance of individual precious metals. In the next part of this report, we will examine the first half of the detailed news breakdown, focusing more closely on the drivers behind market sentiment and the implications for commodities and financial markets.